Most investors rely on outdated stock market sector descriptions that simply don't make sense anymore. Today, we're taking a break from the normal noise to deliver a macroeconomic analysis using a much better framework: financial currents. Think of the market like a massive lazy river. While the herd is distracted by everything on the surface, the real money is made by understanding the deep water currents carrying the entire system forward. In today's video, we're defining the exact macroeconomic currents shifting global capital right now, cutting through arbitrary Wall Street terminology, and showing you how to position your income strategy for long-term growth. Hello, my name is Daniel Young, and this is Adaptive Perspective. Every week, we separate currents from noise and opportunity from fear using an income-focused strategy in closed-end funds. It's not polished, it's not scripted, definitely not herd thinking. We don't chase headlines, we navigate markets. Now, let me be clear. I'm not a financial advisor or a fiduciary. I'm an income hunter, a strategist who filters the noise, follows the data, and targets durable cash flow, even when that means taking a different course. So let's step into this week's waters and see what's actually moving. Most investors study stocks. I study water. And that may sound strange, but if you understand the water, you'll understand why some investments move effortlessly, there we go, while others fight the current. For months, I've talked about financial currents, waves, ripples, and tides. Today, I want to go a step deeper. I want to teach you how to read the water, because once you understand the water, you'll stop chasing reflections on the surface and start recognizing the currents that are quietly carrying the market forward. So let's start with a smaller contained body of water. Have you ever been to a water park with a good lazy river? You step into the water and immediately feel it pulling you. You can swim, float, paddle, but regardless of what you do, the current keeps carrying you forward. The strongest part of the river isn't actually what you see on the surface. It's deeper. The deeper water contains more volume, more weight, and more force. Your eyes see the surface, your feet feel the current. Now, ingrain that in your head, because the stock market works exactly the same way. Most investors only see the surface: headlines, breaking news, price movements, market predictions. All of that is surface interaction. The deeper financial currents are what actually move capital. And if you can identify those currents, investing becomes much easier. But here's where I diverge from the traditional stock market analysis. Most analysts divide the market into dozens of sectors. You've seen them all: technology, communication, consumer cyclical, consumer defensive, industrials, healthcare, utilities, financials, and on and on and on. The problem: what do they even mean? I mean, most of those categories overlap. Technology and AI exist in nearly every category, and energy impacts nearly every category. Modern businesses don't fit neatly into the old boxes anymore. The reality changed, and the labels survived. So instead of organizing investments by outdated categories, I organize them by financial movement, not sectors, currents. When I look at the market today, I see four primary currents. Current one, bonds and select bond proxies. It remains the strongest current. It's not flashy and doesn't dominate headlines. Bonds finance expansion, growth, infrastructure, and innovation. They are the capital behind the next phase of the economy. Current two, real estate. Housing pressure is easing. Financial conditions are improving. Real estate remains one of the largest beneficiaries of lower rates. Current three, end-to-end energy. Oil, natural gas, utilities, pipelines, refining, transportation. Without energy, nothing else functions. Every single expansion story ultimately depends on energy. And four, the technology family tree: hardware, software, semiconductors, networks, applications, AI. And this is where most investors focus and many get lost. But technology doesn't stand alone. Technology, de- Technology depends on the three currents above it, which is why AI isn't the lead current. It's the visible current, but the deeper currents are financing it. So think about what's happening right now. Ghost jobs are disappearing, supply chains continue stabilizing, energy production continues expanding, competition for resources is easing, and the economy continues to grow. Individually, none of these would impact the system. However, together they are indirectly moderating inflation. The Federal Reserve hasn't cut rates yet. When they do, the dam partially opens. The bond current accelerates, capital flows faster, and the effects move downstream into real estate, energy, and technology. While we wait, the market remains obsessed with headlines. The herd sees the waves and searches yesterday's market for reflections. We continue studying the currents and positioning inside the currents, still carrying tomorrow's market forward. That's the difference. So, with that in mind, let's move into this week's closed-end fund snapshot and look at all the funds positioned inside the strongest active currents. So let me share my screen. There we go. So consider it a top 10 pack. Every current a triple asterisk except for IGR, which I've discussed in the past. Um, and I'll get to the two at the bottom that don't meet the 9% rule. Currently, they are ranked based on descending yield, and it's a 10 pack. And honestly, I could advocate or recommend all 10. But I'm going to do this based on my portfolio. So we own everything in blue: PDI, great fund; AWF, PDT at the bottom of the list, still great funds. So we own 23 funds. Would I add two more? And on my end, 25 has been my threshold, my limit of funds. And you can even argue at 23, maybe that is my end of funds. But the two funds that I have tracked and sought are discounts this week, or say our triple asterisks this week, and it makes them tempting when I don't already own them. So where to start? Well, here at 25 funds, that's kind of that's my, I don't want to say hard line limit or soft limit, but that's my limit. That's where I always envision myself stopping. Some people advocate for more, some people advocate for less. I think after 25, it gets very uh, it's hard to spread your investment at 25 plus funds. Um, that's that over diversification mark for diversification's sake. And you could argue the same really at 23 or 20 or 15. It just kind of depends on what person you catch on the day. But on my end is 25. So if I'm buying for me tomorrow, and I'm not because I bought 2 weeks ago and I'm still behind. I have still get, still, I'm not caught up. I bought 2 weeks ago. I've not updated my portfolio. Um, quite honestly, as much as this data is current, I like for my entire portfolio to be current before I make the next decision. But if I was buying tomorrow, what would I invest in? I could advocate for PDI. However, we already own three PIMCO funds. Do I really need another one? No. And that's not to say it's not a good fund. It sounds like a great fund, but I already have three funds and they all seem to overlap a little bit. They're not exact carbon copies of each other, um, but they're very similar. PDI and PDO are similar funds. They're sister funds. Biggest difference would be just on face value that PDO has a termination date or say it's a limited term fund. So in 7 years it'll close, but 7 years is a long time. Um, so between PHK, PTY, and PDO, do I really need to add a fourth fund? For me, no. Doesn't make a lot of sense. So as great as a fund as it sounds, it's well discounted. It's got a fantastic yield. I I realize that I'm willing to be more aggressive in my funds for whatever reason. Some people would say it's my age. I just think it's my style. Ivison and PIMCO are a well-known commodity, and they do a fantastic job managing their funds and also paying the dividends. So it's I I don't know if it's my style or theirs, maybe a combination, but I like their style. But I don't need a fourth PIMCO fund, so I would take that off. BRW remains my largest uh, single uh, largest single investment inside my portfolio. I'm trying. It's not that I don't like it. I mean, it's a steal at 655. Um, Reasons I hold back are its ongoing talking or the ongoing talks of merger between BRW and Saba. Uh, Boaz Weinstein, who owns BRW or owns Saba, has been talking about buying private credit, which I think is why the portfolio has fluctuated a little bit. Um, but I'm trying not to, I don't want to say imbalance, but that is the right word, where BRW is crazy here and everything else is down there. I don't want forced equality amongst my portfolio. Like, I don't want to lift portfolio shares just because, but I am trying to stay away from BRW. Um, think of how I want to say that, or maybe that's not a great way to say that. Uh, but yeah, I own a lot of shares. He's been heavily diving into the private credit market, which is kind of sketchy at the moment. And yeah, there's all this uncertainty about merging. So I'm kind of a hold off on that. IGR has been on my tentative list. I debated while it was in slight premium. Still doesn't meet the triple asterisk rule now, but it's a dollar cost average move. But if I'm looking at the best possible place to put money, overall, it's bonds and bonds proxies, and real estate is second, but it's a close second. So it could be a tentative buy. HGLB, I like the portfolio. I mean, I'm not a huge portfolio in a can guy, and they've really started to spread out a little too much, I think. But what I dislike about HGLB's portfolio is also what I love about their portfolio. They've got about 5% investment into Fermi, which is this AI data driven company with data centers opening or hoping to open in North Texas, but they have yet to list a tenant. And at a 5% wedge of the portfolio, that is potentially disastrous. And maybe not disastrous like the fund will close, but it's gonna lag on that price for a little bit. So while it's kind of the same thing. It's a great dollar cost average pickup, almost not quite at that price for me. If it dipped a little more, it would be a great dollar cost average pickup. But longevity wise, if Fermi continues to drag down their portfolio, then it's maybe not the best timing or best time to buy right now. Let's see. So we own all of this. And in recent weeks, I've talked about all of these at length. And I really don't want to do that again. So I'll show the contact cards. You can read about the funds. Just pause the video and keep reading. And then you can continue looking at each fund. Let's see, there's the top, there's the bottom, AWF, top, bottom, BDT, top, and then bottom. So of the list, I could advocate for any of them. AWF has been on my wish list for a while, PDT as well. And the different, I guess, how it's different from those four funds above it. I mean, they're all bond plays to a degree. AWF just uses almost no leverage, which it gives us this incredibly stable dividend. So whether US rates or emerging market rates are up or down, it just pays this incredibly steady dividend, which you can argue for and you can argue against. Is it doing the same thing that those other funds above it do? Yes, it's similar. Is adding it a decent diversification? I don't know. Uh, as much as it's been on my list of sought after funds, it would take an AI deep dive between HIMCO Double Line and AWF to see if they really differ on approach outside of the leverage. If they do, if they invest into the same stuff, it's a different manager with a different approach, less leverage, and overall less yield. Is even though it's different, and even though it's been on my hit list, it doesn't sound like the best place for my money. PDT is slightly different. So it's a hybrid preferred fund. Almost 50% of their investments are into preferred shares. So it's kind of like a bond proxy, but it's a sleeper energy fund. And in lower rates, they've paid special dividends. So and if you pay attention to my screen, maybe you know where my thought process is going. So in current interest rate territory, it's this incredibly consistent yield. But in a lower rate market, it's a slightly higher yield. And while I enjoy buying 9% higher funds now that just can continue cranking out that dividend, I do like buying funds with lower yields that I believe are set to rise. So if we change the dividend of to what it would be, then we would get a, if we bought at this price, we would get about a 9% dividend in a lower rate market. And I still think we're moving towards a lower rate market. And that's not to say I expect PDT to pay special dividends every year or that they'll be as crazy as they were in the past. I mean, gosh, we'd all love that much of a special dividend. But of the current market where it's bonds and select proxies, which that hybrid preferred is very much like a select bond proxy, it's also got that sleeper energy fund embedded inside, which for whatever reason is challenging to see right now. Let's see. If I add a ton of rows under, there we go. You have all of this energy, right? And all of these, oops, all of these pipelines and utilities buried inside their portfolio. It is very much a sleeper energy fund. It just pays a lower dividend because of the rates. So while I could advocate for them all, if you're going to force me to pick, it would take an AI search to really compare these funds, which I haven't done. You could argue that I should have done it already, but I haven't. Right? It would take an AI search to determine if AWF is really different from these other funds above it. IGR is the great dollar cost average move. But if AWF isn't so much different as these four other funds, and in DSL, I mean, we owned that double line fund too. Those two funds are different. DSL and DOY, different things. Same owner, different things. Versus PIMCOs tend to overlap a little bit. But if they're really not that different, and it's just more of the same and doing diversity stuff for diversification's sake, that's not me. So the best thing on my end this week is to, I mean, yeah, yes, I could pick up any of these at decent dollar cost average moves. I think PDO and PTY especially. But if it were me on Monday investing, I would buy 100 shares of PDT because of their preferred cost, 50% into preferreds plus the energy component. Um, that's just a great fit for this market. So take it for what you will. Yes, it's a final list of seven, but it really hinges on how that set, how that was that, I guess that's a five pack, on how that five pack of funds truly integrates and overlaps. So if AWF is completely different from the other four, then it comes down to, as much as I enjoy the steady rate, regardless of interest rate market, as much as I enjoy the steady rate, I mean, gosh, you could argue for it because it's incredibly steady. What it's missing out is if they leveraged it, if they borrowed it to invest further, they would get a much higher dividend. They would essentially juice their own dividend. So in an accelerating economy, do I really want to put my money into something steady or something that will grow faster? And I think I still lean toward PDT. There we go. So take it for what you will. So I'll leave you with this. Most investors spend their time looking at the surface. The herd watches the splashes and searches yesterday's market for reflections. We measure the flow and position ourselves in the currents, already carrying tomorrow's market forward. That's the difference. And it's much easier to invest knowing the currents. Final seven all fit into the current. It's not so much picking a right fund, which is where even I get distracted because I'm a data guy. I want to pick the best possible thing for me. And explaining that sometimes doesn't always come through. But I want to pick the best possible thing for me and my portfolio. But on your end of things, you have to decide what's best for you and your portfolio. I doubt we hold the same exact things in our portfolios. It'd be amazing if we did, but I highly doubt it. So, based on you and your awareness and your learning and your understanding of the market, and also based on your, it's not so much prediction, but your thought process of where you believe the market's going. My advice is that you invest inside the current and it becomes much easier to pick funds versus if you're just targeting the reflections in the aftermath, you're trying to cherry pick funds based on yesterday's market. And those may or may not be in the current. Probably not because the current keeps flowing. The reflections just stay behind. So any of that final seven pack could work because they all exist in the current. It's just picking the best possible place for your money amongst the seven. And maybe that's something you already have, and maybe that's something you want to pick up. On my end of things, given the options, all seven are amazing picks. They could all work. It just comes into the sometimes the small and the minute details of where that final decision would go. And between AWF and PDT, two funds that have been on my hit list for a while, in this market, I lean toward PDT. I just do. On your end of things, that's what you have to figure out. So that's all I have for the week. I wish you well. Whatever you have going on this week, I wish you success and progress, and that whatever you have on your to do list, I do hope you get to cross some things off. So that's all I have. I wish you a great week. Have a great week, everybody. And I will see y'all next weekend. So have a great Monday. Bye bye.